Echo 64 here, home of alternative economics and contrarian views. It's Wednesday, March 18th, 2020. Today I have Jim Rickards. He's the New York Times best-selling author of The Road to Ruin, The Death of Money, Currency Wars, The New Case for Gold, and Aftermath. And I've got all of the books here, of course, as well. I've read them all. Aftermath is actually online for me, so I don't have the physical book. Thank you very much for giving me some time to speak to my viewers and to me, of course. And I thought it would be good to talk to you. And luckily, one of my viewers knows you, and she's been in contact with me, and you were kind enough to give us some time. With that, I just wanted to know what you think about what's been happening in the markets since last year, since the Fed reversed their rate hikes and QE, the repo crisis that started in September, and now the current crisis, health crisis. I was thinking the other day, and I even made a video about the IceNine analogy that we made. Are we close to that? What do you think?
Well, I think we are. I'm not going to say it's going to happen, tomorrow or the next day, but we're uncomfortably close. So probably a good idea to explain what we mean by IceNine. This is something I wrote about in my book, The Road to Ruin, which came out in 2016. As anyone who's read that book is familiar with the idea, but for the viewers who haven't, maybe just a little explanation is helpful. The phrase IceNine is something I took from a very famous author named Kurt Vonnegut. Most people have heard of Kurt Vonnegut. He wrote a book, a great book, I highly recommend it, in the 1960s called Cat's Cradle. And the theme of Cat's Cradle, there was a physicist who had discovered an isotope of water, and he called it IceNine. And it had a couple characteristics. Number one, it was frozen at room temperature. And if you poured it, it was a liquid at room temperature. And if you poured it into water, it would turn the water into ice. So if IceNine came in contact with H2O, it turned the H2O into ice. But that would spread. And so and he just had a little vial of it. He gave one each to his 3 children. And if you poured it into a stream, let's say, the stream would freeze, but so would the river and the ocean and all the seas, and the entire planet would turn to ice, and life on Earth would cease. So it was a doomsday machine. This was written during the Cold War, during the time when everyone was concerned about nuclear warfare. Probably should still be concerned, but that was a big topic at the time. So what I did, I took Kurt Vonnegut's idea and the name IceNine, and I brought it over into financial markets and capital markets. And I said, because a lot of people talk about, shutting stock exchanges. We hear it today. In fact, in the U.S., we have these so-called circuit breakers, and they've been going off with regularity the past couple of weeks, where if the market drops a certain amount, they shut the market. Now, they just shut it for 15 minutes, then they reopen, and then if it falls further to another predetermined threshold, they shut it for a longer period of time. And if it happens too late in the day, they close the market for the day, and then they reopen the next day. So that's something like IceNine, but it's a little different than shutting the exchange, which has happened. In 1914, for example, at the beginning of World War I, the New York Stock Exchange was closed from roughly August 1st to December 1st, 1914. So there you had a case where it was closed for 5 months. So when people say, well, these things will never happen, well, the answer is they have happened, and they do happen. The market was closed for, I think, 4 or 5 days after 9/11. For that matter, the market closes every weekend. So these kinds of market closures are not out of the question, and they have happened. But the point I was making, this is where the IceNine analogy comes in. If you close one venue, and let's just say the New York Stock Exchange, because it's going straight down, the markets are disorderly, too much wealth is being lost, and they close the New York Stock Exchange. Those who need liquidity, those who want cash, will go to another venue. They'll start taking money out of their money market funds. Well, then what does that mean? Well, the money market fund sponsors have to sell assets, commercial paper, treasury bills, and other instruments to meet the redemptions. So then you have to close the money market funds. So then what do people do? Well, they'll go to the banks and they'll start taking all the money out of their bank accounts and the ATMs. And then, so they'll have to close the banks and close the ATMs. And the point is, it spreads from stock exchange to money market funds to banks to other venues, the same way that the original IceNine would spread from a river to the ocean to the entire world. That's a danger that of this kind of spreading that you have to think about before you close the first venue. You know, closing the first venue won't do you any good if you're just going to go to other venues and have to close them also. So in effect, if you want to close anything, you might have to close everything, shut down the system, call a timeout, and then in some fashion reboot the system. You know, perhaps with something like a new Bretton Woods conference or the intervention of the IMF, et cetera. So that's IceNine at a very high level and a very global level. So, but I don't think many people think of it this way. I described it in a lot of detail in my book. But if regulators are not thinking about it this way, they run the danger of walking into that trap of shutting one venue, perhaps the stock exchange, without understanding that all it's going to do is the demand for liquidity, the pressure, is going to go right to another venue. It's like water running down a hill. If it hits a wall of some kind, it's just going to divert around the wall. It's going to keep going. You can't stop it, but it might take an irregular path. So when people are panicky, when people are fearful, when they want money, they're going to find it. If you shut one venue, they'll go to another venue, and you'll have to shut that too. And that's the IceNine. Now your question is, how close are we to that? Well, we're close. Again, the circuit breakers are good to a point. It was a good idea. By the way, the circuit breakers came into existence in the late 80s, early 90s, in the aftermath of the 1987 stock market crash, when the stock market went down 22% in one day. We see days now where it goes down 10% in a day, which is a lot. And maybe it does that 2 days in a row. So you can get these big drops, but 22% in one day had never happened. That was the largest one-day drop percentage terms in history. And they wanted to prevent that. They said, panic feeds on itself. And so when we have something like that, a panic in effect, we need to call a timeout, give people a little time to think, gather their thoughts, think about whether there might be some bargains out there, give regulators time to respond, give the president time to do a press conference, offer some reassuring words. And, it's like getting a good night's sleep. Sometimes you get spun up on a problem and you get a good night's sleep and you wake up and the solution's very clear. And that was the idea. And that was the idea of circuit breakers, and they seem to be working. But if it keeps going down, even with the benefit of circuit breakers and a good night's sleep, then at some point they may have to shut the markets for the good of the markets. But that won't be the end of it, and that's really the point of IceNine. And we're getting closer to that point.
Yeah, and we can see that the central banks are trying to stop, closing the markets, because the Fed yesterday announced support for commercial paper, and they allowed also primary dealers not to use other assets other than treasuries and mortgage-backed securities. Can you tell the viewers about your newest book, Aftermath, and where you could see the monetary system going? Because a lot of my viewers, of course, are into gold. I'm a gold bug, I have to admit. And where do you see the monetary system going? Because a lot of people think you are pro SDR. I don't think you are, because I read Aftermath, and you say in that book that the best system would be probably, from what I understood, going back maybe to the 19th century market-based gold standard, but you don't see the politicians or the elites wanting that.
Well, that's right. And people, when you're an author or you do interviews or you have a high profile, people always want to put words in your mouth, and they get confused between what I'm forecasting and what I personally advocate. So I am forecasting SDR intervention. I am forecasting that in an extreme liquidity crisis, if there was a loss of confidence in the dollar, and you would know that by the price of gold soaring, and I don't mean $10 an ounce or $50 an ounce, but imagine $200 or $300 per ounce per day. That's the kind of price action I'm talking about. And everyone would say, oh, the price of gold is going up. And I would say, no, the dollar's going down. In other words, if you privilege the dollar as your numeraire, as your way of counting, yes, the higher dollar price for gold means gold's going up. But I don't do that. I think of my yardstick as gold by weight. And so when I see the dollar price of gold going up, I say to myself, well, it takes more dollars to get your ounce of gold. And that means the dollar is actually going down. So it's just a different way of thinking about it. The math is the same, but the paradigm or the frame in which you understand it is completely different. So, but in that world where the dollar is losing value and people are losing confidence in the dollar, you're going to have to do something. Step one, and I talk about this a lot in my new book, Aftermath, which came out last year, but also The Road to Ruin, which I mentioned in 2016 and other writings. You can start by closing a stock exchange or closing the banks, but you get into the IceNine situation. So let's say you get your time out. Okay, what's your answer? What's your solution? The problem right now, and you're right, the Fed is going back to the 2008 playbook. So that you're right, they did a primary dealer facility. They have now, in effect, guaranteed or provided liquidity in commercial paper. They've done more than that. They've now gone to QE4. They've stopped pretending that it's not QE. They're going to buy long-term assets. They've cut rates to zero. Obviously, I spoke to some Federal Reserve officials last summer, and they said that negative rates are on the table. That surprised me a little bit. I knew you could see rates were going to zero, but I was surprised that they were so relaxed about the possibility of negative rates. So they're doing all the things they need to do to keep the plumbing of the system open. But that by itself won't solve the panic. That won't cure coronavirus. That won't get people, out of their houses and spending money again. That's a completely different task. And so if you get to the situation where you've had to close banks and exchanges, how do you reopen them? And particularly if there's a loss of confidence in the dollar. Well, there's only one clean balance sheet left in the world. I mean, the problem with the Fed is they took their balance sheet from $800 billion to $4.25 trillion between 2008 and 2014. But they never got back to normal. They never got to anything close to, so let's say $2.5 trillion or $2 trillion. And now they're back up over $4 trillion because of the new easing programs. So where is the invisible confidence boundary? Where is the point where, can you go to 4 trillion, 5 trillion, 6 trillion, 7 trillion? I mean, some people say yes. The modern monetary theorists say yes. Legally, it's possible, but in my view, that won't happen because there is this invisible barrier where people just wake up one day and say, wait a second, what's going on here? I'm not an economist, I'm not a monetary expert, but I want to get out of the system. Get me some gold, some silver, real estate, fine art, something tangible. I no longer have confidence in the dollar. Well, who's going to restore confidence? Where will the liquidity come from? Maybe that's a better way to put it. And the answer is the IMF has the ability to print special drawing rights. That's world money. Now, it's not what we call walking around money. You're not going to have any, and I'm not going to have any. We're not going to use it to pay for dinner, but it can be given out to countries. And it can also, not many people know this, but I've read the relevant articles and bylaws. It can be given out to multilateral institutions. The IMF could print SDRs and give them to the United Nations, for example, as well as their member countries. And so it may come to that. So you may see 1 trillion SDRs printed up and handed out to countries around the world and or to the United Nations as a way to get the wheels turning again at a time when people have lost confidence in the dollar. We're not there yet, but again, we're getting uncomfortably close.
Yeah, and from what I read in Aftermath, you were warning people to have a lot of their savings and investments out of the system. You warned them that they should have some physical gold, some alternative assets outside the stock market. And I think that's good advice. It's what I've been telling people, to be outside the system. The other point I like to make, and to finish off, you say that your ideal situation or solution for a monetary crisis would be a conference at Mar-a-Lago to set up a new gold standard, right?
Yeah, I use Mar-a-Lago as an example. I have a chapter in Aftermath called the Mar-a-Lago Accord, obviously after Bretton Woods Accord. And it's interesting. Mar-a-Lago, it's a little glitzy for my taste, but it bears some resemblance to the palace in Genoa where they had the 1922 International Monetary Conference. It's the idea would be that would serve the purpose that the Mount Washington Hotel did. That was the place that hosted the Bretton Woods Conference in July 1944. By the way, I was up in Bretton Woods last summer in July to celebrate the 75th anniversary of the original Bretton Woods Conference. That's where I met with some of the central bankers I referred to earlier, and a lot of other. Larry Summers was there, former Secretary of the Treasury, and Gillian Tett, very prominent financial journalist for the FT. So it was quite a gathering. But my point is, you're going to need to reset the system. You're going to need to have another international monetary conference, and I don't know how you do that without gold playing a role. I'm not saying that you're going to go back to a strict pre-1914 gold standard or even the kind of modified 1944 Bretton Woods gold standard, but I just don't know how you do it without using gold as a point of reference. And to me, this explains what we've seen in the last 10 years, where China has tripled its gold reserves. Russia has tripled its gold reserves. Many other countries around the world are buying gold. The United States has not sold any gold, any official gold, since 1980. We stopped selling. What the United States did, we put pressure on other countries to sell their gold. So you saw the UK sold about more than half, close to 2/3 of their gold in 1999. Between 2000 and 2006, Switzerland sold 1,000 tons. In 2010, the IMF sold 400 tons. So we were getting everyone else to dump their gold, but if I were any of those countries, I would have turned to the United States and said, hey, why don't you guys sell some? But we never did. We held on to ours. But meanwhile, who was buying? Well, it was Russia and China, Kazakhstan, Mexico, Philippines, Vietnam, Azerbaijan. A lot of countries are buying gold. Poland bought a lot of gold. Turkey, Iran. Not only that, but they're also repatriating their gold. A lot of this gold I'm describing was stored at the Federal Reserve Bank of New York or the Bank of England in custody. It didn't mean it belonged to the United States, but we were holding it for these other countries. Well, one by one, they're calling up and asking to get their gold back, and the Fed has been delivering. But a lot of gold is a little bit of a run on the bank as far as gold is concerned at the Fed and the Bank of England. So when you see the price of gold going up, when you see central banks buying, becoming net buyers rather than net sellers, when you see people asking for their physical gold back because they want custody in Frankfurt or Warsaw or Baku or someplace other than New York, I think it tells you all you need to know. So when this conference comes, whether it's at Mar-a-Lago or someplace else, your seat at the table is going to be determined by the amount of gold you have. So the people who are going to be sitting at the table will be the United States, China, Russia, maybe the European Central Bank. If you combine all the members of the Eurozone, if you combine them, they have more gold than the United States. They have over 10,000 tons. The United States has 8,000 tons. The people who are going to be sitting, on the wall and the seats lined up against the wall are going to be, important countries like Canada and Australia, maybe even the UK, that unfortunately have sold all their gold and don't have any reserves. They'll be in the room, but not at the table, so to speak. So we'll see what happens. But and this won't happen tomorrow. I'm not predicting that, but we are moving in that direction.
Yeah, and I think Canada doesn't even have any gold reserves. The Canadian government.
I think you have more gold than Canada.
Yeah, so they'll probably be outside the room. But thank you, Jim, for your time. It was great talking to you, especially at this time where the markets are so, where, in my opinion, faith and confidence is teetering. And from what you said, it looks to me that he who has the gold will make the rules when things have to be redrawn.
Great, thank you.
Thank you, Jim.